Hey guys, welcome to the channel today. This is going to be one of the first videos on this channel for Savani Finance. It's going to be a really cool YouTube channel, and we're going to be reviewing a lot of different companies. So stocks, publicly traded companies. We'll be reviewing like ETFs, index funds, and mutual funds, as well as just overall portfolio strategy. So it's going to go across a lot of different topics. We're going to be going in depth into 10K reports. We're going to be reviewing the investment companies' outlook, their press releases, and kind of my own opinion on what I think the company's outlook might be. So it's going to be pretty cool. The videos are going to be lengthy, so bear with me on that. I'm also learning through this process as well, so I think it's a good experience, and we should definitely start to review different companies right away. So one of the inspiring people that I think I've looked up to. They have an awesome YouTube channel. Their names are Brian Feroldi and Brian Stouffer. They create fantastic content across different companies, and they review the earnings reports. They make good educational videos as far as how to read financial statements and understanding like free cash flow, the cash flow statement, and the difference between free cash flow and net income. I think that's been pretty instrumental in my investment journey too. All the people that have come before me, I think definitely deserve some props as far as their expertise as far as evaluating a company and coming to an investment decision on that company. So I'm just starting out. I'm very new, so I'm going to be making a lot of mistakes, but I think it's going to be learning through those mistakes. So yeah, definitely looking forward to it. So the first kind of criteria that I want to just start out with would be from Brian Feroldi. So they put together kind of a checklist, an investment checklist that we'll be using for one of our companies today. So we're going to be reviewing American Express. I don't think they've reviewed that yet or done like an in-depth analysis of it. So I think it'd be really interesting to go through. So if you haven't already downloaded this checklist from them, I highly encourage to do so. It pretty much goes through the entire company's analysis, so it goes through the financials, the moat, the competitive advantage, that is, the potential. So pretty much their placement in industry. So if there's any barriers to entry, or how do they stack up against competitors? Then the customers, obviously, that's a huge factor. Company specific factors such as recurring revenue, pricing power, management, and culture. I think that's one of the big sections in here. And then the outlook of the stock, and then kind of like this gauntlet score, I think is pretty cool too. So they have like a criteria, and their criteria, I think, is if it scores, yeah, here it is. So if it scores between like 70 and 79, it's an investable stock. If it's over 80%, it's fantastic, and below 70 is don't bother with it, right? So we're gonna go through this. I've already done one, which is Coca-Cola. So I went through that. Didn't do so well for me personally, but that's just my opinion. And so we're going to be using a lot of resources. So first thing I always do is just pull up the 10K report from the company. And luckily this one's just recently in February. So yeah, so we'll be reviewing this. So we're just going to pull up the financial statements and then the MD&A section as well. So let's go to the financials. All right, so we'll start here. And then the other sources that I'll get to, obviously we'll use Yahoo Finance for American Express. And then on their website, every publicly traded company should have this. So they have an investor relations page. So you can find that by just going to the website and then scrolling all the way down here to investor relations. So this is where they'll post. Honestly, I could have just done it straight through here, but I just like trusting like the SEC database and the accuracy of the reports. But anyway, so they have the events coming up. They have the quarterly earnings. They have the news headlines. They have the SEC filings here that you can access. The annual report and proxy reports for the next year's outlook, and then corporate responsibilities such as ESG. So fantastic that they have that on their page. And so from the earnings page, obviously the most recent one is Q4 of 2022. So we'll be going over the press release, the presentation, and the financial tables. So it's kind of a lot, but I think we should just breeze through it. We'll mainly be focusing on the SEC 10K report and just doing our analysis from that. But this gives more insight as far as the company and like the people, the amount of people that are actually invested in the company. So it gives better insight into the customers, the company's moat, and also the board of directors situation with the company. So I think that's really important. So I have here is the Q4 earnings release, the earnings presentation, and we'll also pull up the financial tables as well. So actually, no. So this is actually straight from SEC, so there's no need to do that. So we'll just go to the financials. Okay, so why don't we start off the score? So basically the first thing is financial resilience. So is it fragile, average, or fortress? So financial resilience, obviously, we're going to be looking at net income. So basically, we're gross profit margin, operating profit margin, and net income margin. And then from the free cash flow side, the growth in free cash flows over the trailing 12 months, and the balance sheet and the strength of the income statement as well. So those would be things that I would watch out for. So why don't we just take a look at that? So I'll also have my calculator here so that we can review this as we go. Okay, awesome. So let's go over, so this is the income statement right here. Okay, so let's go to operating, or sorry, gross profit margin. So gross profit margin would be revenues minus COGS, right? So that would be gross profit margin, but I'm trying to find where that is. So you got revenues here, you got interest income, interest expenses. So every company has a different way of reporting it, but I think it should be after just cost of goods sold. But since this is a credit card and a bank, pretty much, it's going to be a little different. So the deposits with banks are their interest income, and they have interest expenses. So I think we should do right after interest expenses and maybe credit losses. So right before the operating expenses kick into play. So we'll get that first. So total revenues net of interest expenses after provisions of credit losses. So we'll be comparing these two numbers to the revenues. So total non-interest revenues. So actually, now that I'm thinking about it, it doesn't make sense because their revenues are increasing. I mean, not increasing. The revenues are being added to the interest income, and then the interest expense is next. So this is a weird way of evaluating it, but let's just look at how it's growing. So revenue from 2021 to 2022 has increased by $7 million. So that's a good sign. Before that, it was increased by 12 million. So it has decreased in growth since 2020. But I think that's still in decent shape. We'll also look at income, how that has grown. So grew substantially from 2020 to 2021, has taken a stabilization period here in 2022. at around 7,500. So I don't think that's too much of a concern there. And then let's also look at the free cash flow. So remember, free cash flow is your operating cash flow minus any capital expenditures. So we're going to be taking a look at our cash flow statement and seeing where our operating cash flow is. Here you go, net cash provided by operating activities. So let's see the growth in free cash flow. So we have 14,645. Then we're going to be subtracting out our capital expenditures. So let's see what they define as capital expenditures. Not that, acquisitions are separate. Purchase of, equipment. So equipment's going to get subtracted. So 1,550. Increasing loans and receivables, no. Purchase of investments, maturities and redemptions of investment securities, sale of investment securities. So I think purchase of investments would be included in CapEx. So we would subtract out 1,517. Okay, so we're left with 11,578 in free cash flow, and just gonna write that down real quick. So 11,578, and then the next one is 21,079. I can already tell it has increased, but we can just double check. 1,475, and then minus the purchase of premises and equipment of 1,855. Okay, so 15,049. So it has increased by roughly, let's do the quick math here. Increased by 30%. So free cash flow has increased by 30%, which is a good sign. Means that they have more cash to spend on necessary things to grow the business further. So that's a good sign. Now let's look at the strength of the balance sheet. So we'll look at the liquidity ratio, and we'll also look at just making sure that their assets significantly outweigh their liabilities. So this is it. So we're looking here. No, this is shareholders' equity. This is cash flow statement. I missed it. There it was. Okay. So total assets at 228,354. Liabilities at 203,643. Still in decent positions. Debt to assets is below 1. So that's a good sign. And then the debt to equity ratio also 203 to 24,711. That's okay. Mainly we're just looking at the debt to assets ratio and just making sure that they have decent amount to cover their liabilities. So that's a good sign. Okay, and we can actually get some more like kind of more granular figures from Yahoo Finance here. Just seeing other ratios that could be at place. So we go to the analysis here. We'll look at the, do they have the ratios listed here? The balance sheet, they have the cash flow statement. They don't really go in depth as far as the stats go, but let's see. Okay, so here you go. So here you have trailing PE ratio, forward PE ratio, the price to sales, price to book, price to earnings and growth, and other items there. So this is where we should look at, because this is kind of all of the different ratios. So return on equity is pretty solid at 32%. And return on assets is 3.6%. Remember, return on equity is essentially cash flow before tax. So the before tax cash flow divided by total invested equity, essentially. So that's 32%, which is solid. Then here you go, the debt to equity ratio, really high, in my opinion. But the debt to assets is not listed here, but that's something we would watch out for. But okay, so that's that. We want to look at the price to earnings, but let's look at a trailing PE ratio. So we don't have too much access to this, but that's okay. But generally, the PE ratio, I don't like to base it just off of the PE ratio. I just like to analyze the company thoroughly. But 16.52 is not terrible. Would like to see it maybe above like 20. Same with the forward PE ratio. The price to sales, 2.33. Can't really make any inferences off of that because don't have past figures. Price to books, enterprise value to revenue, and enterprise value to EBITDA. Some interesting figures there. Here we have profit margin at 14.83, operating margin at 19.81. Not that bad. So it looks like they're still increasing. Actually, you can't tell because it's just one quarter's data. So we would just want to look at this and just analyze this pretty much thoroughly and just see where the growth is. Earnings per share, let's see where that increased. So the diluted earnings per share actually decreased by 17 cents. So yeah, and overall not bad. I don't think they're in that bad of a situation. So I'm gonna give them a 4, I think. I think there is still a little bit of concern as far as some items on the financials, but I'm gonna give it a 4. Gross margin. So gross margin was I don't think they had gross margin listed, but yeah, so they don't really have gross margin, so you can't really tell off of that. But it did slightly decrease from 2022. You saw it like at 51 million, and then before that it was, or it should be 51 billion. I keep saying million, should be billion. But yeah, you saw that it increased from 43 or 44 to 50, close to 51. And then before that, those 31. So still a slight decrease in gross margins. So I think we'll give that a 2. Return on capital. So we'd be looking at the return on equity and the return on assets. So the return on capital, not too much growth for return on assets, but return on equity was 32%, which is pretty fantastic. And we can look at that right here. So go to the balance sheet. So we would take the equity. Okay, so we'd take the net income divided by the equity. So net income here is 8060. We would take that and divide it by the shareholders' equity. This is 2021, so 22,117. So 36% for 2021. And then 2022, it was close to 24,000 there, so 24,711. So actually we took a dip in the return on equity. So it was at 36% in 2021, and now it's at close to like 30%. So a little bit of a dip there. Just need to remove this one sec. Okay. So yeah, it took a little bit of a dip there, but it's still not in bad condition. So I would think that this is still a three in my opinion. Oh, if it's a plus one, if it's rising, okay, so maybe it should be a two. Um, okay, so we'll just keep it at two. Free cash flow. So we saw free cash flow increase by a little bit. So that was a good sign. So I think free cash flow is in a good position. Earnings per share slightly declined, so it should probably be maybe like a one pointer there. Network effect. So this is where we'll learn more about the actual company product ecosystem. So we'll review some of their um, uh, earnings reports. I mean, that's just earnings actually. So what we should look at really would be um, the investor relations news, if there is any. So some companies have like an investor day, which pretty much they give good guidance as far as their outlook, their competitive advantage, and stuff like that. So it looks here, Amazon delivers on 2022. Oh, that's the tab I had opened up. So um I don't think they post anything as far as the actual competitive environment. See, this is all just like earnings related analysis. Um, really isn't too much as far as the company's outlook. But why don't we read the MD&A from the 10K? I think that'll give good guidance as far as where they're positioned. So we'll go back up here. We'll go to the management discussion and analysis page right here. Okay. So we're a globally integrated payments company with four reported operating segments, consumer services, commercial services, international card services, global merchant and network services. So they have four different types of services. A range of products and services include credit card, charge card, banking, other payment and financing products, merchant acquisition and processing, servicing and settlement, and point of sale marketing, information products and services for merchants, network services, other fee services, including fraud prevention services and the design of the operation of consumer loyalty programs, expense management, product and services, travel and lifestyle services. So broad range of services, so that's a good sign. So what are we comparing right now? So we're just comparing network effect and product ecosystem. So I think their products and services are pretty fantastic. They cater towards a lot of different areas. So obviously the travel and lifestyle is huge. I don't know what exactly their bonus rewards programs are for travel, but I'm assuming they pay attention to it. So that's a good sign. Credit card, change card, banking. So their personal checking and business banking is actually solid. They also have a credit card account as well, so that's great. They have cash management products and services. All right, let's just keep reading here. Discount revenue or largest revenue source represents the amount we earn and retain from merchant payable for facilitating transactions. Okay. Interest income principally represents interest earned, blah, blah, blah. Outstanding loan balances, net card fees represent revenue earned from annual card membership fees, which vary based on type card and number of cards for each amount. Service fees. So they're going through all the different types of fees. Processed revenue primarily represents revenues related to network partnership agreements comprising royalties, fees, and amounts earned for facilitating transactions on cards issued by network partners. Okay. They have some non-GAAP measures as well. So now they're gonna just talk through some of their financial performance. So what do we have here? So we have selected metrics and ratios. So these are the things that they like to look at: return on average equity, net interest income divided by average card member loans. That's an interesting figure. Net interest yield on average card member loans, effective tax rate, and common equity tier. Interesting. Um, doesn't look like they have any preferred equity investors. But yeah. Okay. So why don't we read this? I think this will give good guidance. So our results of the year demonstrate that our growth strategy is working and our business is in a stronger position today than before the pandemic. Spending on our network reached record levels and credit metrics remain below pre-pandemic levels. Our investments in product innovation, technology, people, and our brand has led to increased generational relevance with millennials and Gen Z customers, record new card acquisitions, deeper relations with customers, and expanded merchant acceptance. For 2022, we reported net income of 7.5 billion or 9.85 per share, compared with the net income 8.1 billion. So net income has decreased. A reduction in net income reflected credit reserve builds and not net losses in our Amex Venture strategic investment portfolio in the current year, compared with sizable credit reserve releases and significant net gains in our Amex Ventures strategic investment portfolio. So the Amex Ventures is what's causing a little bit of lag in the net income growth. So interesting to see. Worldwide network volumes of the year increased 21% compared to the prior year. Build businesses, which represented 86% of our total network volumes and is the most significant driver of our financial results, increased 23% year over year, demonstrating our continued ability to acquire, engage, and retain high-spending premium card members. U.S. consumer build businesses grew by 24% year over year, reflecting continued strength in spending trends. And from our premium U.S. consumer card members build business in our commercial services segment grew by 21% year over year, reflected continued growth from U.S. small and mid-sized enterprise customers, as well as continued steady recovery in spending by our U.S. large and global corporate clients. International build businesses grew by 23%. Okay, so they're seeing growth in pretty much all the different types of businesses that they cater towards. So ranges from small to medium sized to institutional sized companies, and driven by strong recovery in spend across both consumer and commercial customers. T&E, I'm not too sure what that is. Spending momentum remained strong throughout the year, while year-over-year goods and services spending growth slowed towards the end of the year following the large pandemic recovery growth rates experienced earlier in the year. Inflation was the modest contributor to our strong build business growth, while the continuing strength of the US dollar relative to the prior year against most major currencies in which we operate had a negative impact on our international billings. Total revenues net of interest expense increased 25% year over year. So they're looking at the revenue subtracting those interest expenses that we saw earlier. So that's the revenue that they're looking at as their pretty much driver. And it could be technically considered a gross profit margin. So that could be considered the gross profits, but it depends. This is an interesting industry and a different way of looking at the financials. So reflecting strong growth in our revenue lines, discount revenue, our largest revenue line, increased 25%. So I wonder what that is, the largest revenue line. I'm assuming it's their credit cards. So momentum in our card member spending volumes throughout the year. Net card fees increased 17% year over year as new card acquisitions reached record levels in 2022, and card member retention remained high, demonstrating impacts of investments we had made in our premium value propositions. Service fees and other revenues increased 36% year over year, driven by higher travel-related revenues. Net interest income increased. Okay, so it looks like everything is increasing. So they're saying it's increasing, but actually the net income is decreasing. So there must be some operating expense that is causing that. So What we looked at, or what they mentioned, was their Trout Amex Ventures. So if they could maybe explain how much money they're spending on the Amex Ventures, that would be helpful. Let's go down here. Okay, so expenses. So they have card member rewards, business development, card member services, marketing, salaries, and employee benefits. So let's see the growth in these items. So salaries, that's okay. So next is marketing. So not too much increase there. But from 2020 to 2021, they did increase it substantially. Card member services. So this increased by close to $1 billion. So maybe that's what's included in the Amex Ventures. It could also be business development. So that also increased by $1.2 billion, and card member rewards. So basically, they might be charging some external or more rewards with these Amex Venture cards. So so if you total that up, 3 billion there, 1.2 there, and another billion. So close to 5.2 billion they might have spent on the Amex Ventures, or it could be like a slight portion of that. So that has definitely impacted the net income. So those were just the major expenses that I saw increase. Yeah, and definitely it has increased. The expenses are growing from 2020. So from 2020, it was like 6 years. Now it's, 6 billion. From 2021 to 2022, it's roughly 8 billion. So definitely an increase in expenses. So let's go back to that MD&A section, just finish up where we left off. And then we'll get into the rest of the quality score and finish off American Express. So they have the results of the operations, okay? So they're looking at total revenues net of interest expenses. So this was what they were mentioning here in that discussion of how everything was increasing net of interest expenses. I'm just skimming through this, seeing what this has to say. So they talk about the common equity tier. Okay. Okay, I think that's pretty much it for the MD&A section. So now we'll just get to the rest of this. So as far as optionality goes, or sorry, not optionality, as far as network effect goes, product ecosystem, definitely an increase in expenses. So it looks like they're spending more money on marketing. They're spending more money on these new products and services. So they're putting effort into that, which is a good sign. If it's successful or not, that remains up to question, but I still think it's relatively strong. So that's why I'm going to give it a 13 out of 15 there. Switching costs. Okay, so switching costs, basically, if they were to adopt switching costs. Wait, I'm trying to think of this. So switching costs is essentially just if they were to adopt another strategy, how many costs would they incur? Or maybe that's not the right way to think of it. Switching costs, I should know this. Come on. Basically, if a customer is using American Express's, what is the opportunity cost of going to another product? That's essentially what they're saying. And I think there's better products, in my opinion, out there for credit cards. I know American Express has fantastic rewards for business credit cards, but for personal credit cards, there are some very good options out there. So I don't think they have the strongest switching costs. So that's why I'll give it probably a 7. I'll give it a 7. Durable cost advantage, so scale distribution, physical location, and vertical integration. So they are pretty much vertically integrated. They have banking, they have cards, they have travel rewards. So that's a good sign. Uh, and they have a pretty wide range of businesses that they cater towards too. So that's fantastic. I'm just looking through their products and services, but they have pretty good business solutions. They have the checking accounts, they have V payment, international payment. They got some rewards and benefits. So obviously the travel rewards, so the Amex Venture cards, it looks like they're rolling that out and spending a lot more money on that. So definitely this caters towards the travel sector, the hospitality sector, hotels, resorts, all of that, you know. So definitely a big bonus in uh, expanding into that. They've probably had this. They probably just issued probably more different types of cards and different rewards programs. But yeah, so banking wise, they have CDs, they have personal checking, they got some loans that you can pull out. They have investment management services, financial planning, and then business lines of credits and business checking. They have high yield savings accounts too. So card wise, well, why don't we view all the different types of cards? Probably have a vast array of different types of cards, but platinum card, express gold card, preferred card. So definitely a wide range of cards. These are all the travel rewards cards. So this Hilton Honors cards, Marriott Bonvoy, Delta Sky Miles. So yeah, interesting. Since they are in partnerships with these other companies, Delta, Hilton, and Marriott, I would suggest just reviewing the strength of those companies too, just briefly. You can just maybe just look at like the financials and make a decision off of that. But I think pretty much they're investing good money in the travel sector. They have some cashback cards as well, which is great. So this is good to see. I think this is pretty strong as far as their cost advantage. So I'm gonna give them a yeah, close to 13 on that. Okay, intangibles. So intangibles, so basically premium brand, patent, trade secret, license. So I didn't see too much of intangibles. Why don't we look at the statement here? Just look at it in search intangibles. All right, here you go. So looks like it's decreasing. Intangibles are decreasing. Here are the other types. So our amortized straight line basis, blah, blah, blah. Okay. Yeah, so intangibles are decreasing, which is not a good sign. So I don't think that's pretty strong in my opinion. I think we'll probably give it a maybe a 4 at the most. All right, counter position. Competitors won't be harmed to adopt the business model. So are they saying that that's a good sign or that's a bad sign? So basically, if you have a business model that is hard to adopt, that means that you have a very durable competitive advantage and not many people can replicate your business strategy, right? So if it's harder to adopt, then it should be close to a 10. If it's easier to adopt, it should be close to 0, right? So that's what I think is happening here. And I think they have a good business outlook. They have definitely tons of different types of products. So I don't think it's hard to replicate. but at the same time, companies are competing with them. They like such as Capital One, a huge competitor there. You also have Discover, that's a big competitor. So I think they're still holding on to it, but I think it's digressing a little bit. Moat direction. So where's the company's competitive advantage going? And I think it's kind of stable right now. So that's why I gave this a 6. So actually, I'd probably give it, if it's out of 10, probably give it like a 7. So I think it's stable right now. I don't think too much is happening. Obviously, there are larger implications, macroeconomic implications, such as the fall of Silicon Valley Bank, Credit Suisse, tons of different other banks near California. And it might have an impact, definitely, but American Express shows that they responded well, whereas other companies didn't. So I definitely think they're headed in a positive direction. So I'm okay with their moat direction. Optionality, none within industry, new industry. So I think they have some good optionality. So if we were looking at the different types of companies, they were catering towards a lot of different businesses. They obviously expanded the travel sector. The rewards and benefits are fantastic. So you have for shopping, entertainment, and events. So I think they're doing great. So actually, I would give that close to like a 5. Organic growth. So GDP divided by 2x or 3x times GDP plus 15%. So I think what they're trying to say here is I'm not too sure what the GDP figure here is. Yeah, I'm not too sure. Maybe it's just their so my understanding what GDP is sig exum. It's kind of a cool mnemonic, but it's essentially consumption plus investments plus government spending and plus the difference of exports minus imports. So that's my quick little thinking of GDP. But we can just look at the the revenues were pretty solid if we were just looking off the financials. So yeah, revenues were pretty solid at close to increasing from 34 to 42, not the biggest increase, but still actually increasing from the previous year. So that's a good sign. And then total interest income is also increased as well. So that's a good sign. And then interest expenses have increased slightly. But overall revenues after interest expense has increased a pretty decent amount. So that's a good sign. So I think their products are definitely performing well. They're generating solid income. Solid revenue. And they're in a solid position. So I think they're pretty good. I think maybe this should be a 4. All right, top dog and first mover in important emerging industry and industry disruptor. So, out of all the credit card / bank companies, where do you think American Express ranks amongst them? In my opinion, right now, they do have the first mover advantage. Key competitors, like I mentioned, you have Capital One, JP Morgan Chase. You also have Discover Bank and credit card. You also have SoFi Bank, which is another popular one. So there's a lot of different fintech companies that are coming in to the industry. and disrupting the industry a bit. But I still think American Express stands like near the top. So I think them and Capital One slash Visa, they definitely have a very strong moat, and they have the top dog mover advantage. So I'd give that a 3. Operating leverage ahead. So operating leverage, so we would just look at the operating profit margins. Operating margins are 19.81%. Let's just look at the financials real quick and just see where their operating margins are at. So so I think this is what we're looking at right here. So 50,000 compared to 42,000, and then 43,000 compared to 34,000. And that's pretty good. But it's weird because why is the revenues so you would just actually look at the total this is total non-interest revenue, and this is total interest income, right? And then you have the expenses and credit losses, right? So you just look at the combination of this, and then compare that to the total revenue. So you have 12,658 plus close to 43,000, so close to 55,000 there, compared to the revenues at 50,680, so which is fantastic. I mean, that's above like 80, 85 or 90% operating margin. So that's pretty great. And then down here you have 34,000 and then 9,000, so close to 43,000. And then you're comparing that to the 43,000. So I'm not too sure what they define as operating margin. That's a very interesting profitability metric that doesn't really that's not really clear in their income statement. You might have to look at something else, but that's kind of interesting. Okay, so now operating margin, which is basically EBIT, so earnings before interest and taxes. So it's weird because interest expenses are now at a top line area right here. But okay, so why don't we finish off the rest of this? I think their operating margin is decent. Acquisition, so sales, marketing, percentage and gross profit percentage. So gross profit we saw was pretty good. It was increasing. Sales and marketing efforts, we can review that. So why don't we look at marketing expenses? Okay, so we're not going to get that there. We'll get it at the top line income statement. So marketing, definitely they've stabilized that. So they're not spending too much on marketing. Sales is also pretty good, increasing there. So that's a good sign. But marketing, they're not really spending too much money on. So gross profit as well, it's not terrible, expensive, normal, word of mouth. So I think this should probably be maybe like a 3, you know, at the most. Actually, maybe even a 2. But I think no, the word of mouth, especially every person I hear of that talks about American Express says they love it. They love the rewards program. So I think that's probably a 3. Now dependence, highly cyclical, moderate, or recession proof. So I think they're definitely on the edge of moderate and recession proof. Now, given this macroeconomic environment with the banks, I will probably lower that to a 3, but I still think they're a robust company with a strong moat. Now, company-specific factors, so recurring revenue, pricing power. So that's kind of interesting to look at. So historical data, why don't we look at this? Nah, I don't want to look at that. Summary, how about that? So recurring revenue, you just want to look at consistency or even just growth in revenue. So I think that's in a good state. So I definitely give that a 5. Pricing power, on the other hand, I don't know. Maybe they spread themselves out too thin by introducing too many products and services. But as far as pricing power, I'm not too sure on that. So I'd just be conservative and give it a 2. Soul in the game. So this is where we need to find out the board of directors interest in the company. So where can we find that is a good question. So soul in the game, soul in the game. Why don't we look at the about section? I think that will give us some insight. Wait, actually, I didn't even see these. Okay, so they have these are all the products and services. They have the contact us global network careers. What is this global network? So they do have a solid network of acquisition companies, developers, issuers. So why don't we learn more about that? So issuers are they don't really say anything about that. Oops. Okay, so acquires. I don't see anything. Okay. Yeah, but we need to go to that about section. So where is the about section? Okay, let's go down here. Back to the home page. Let's go to keep clicking on the wrong stuff. This video is probably way too long. I should have like prepared beforehand and just done all this research and then just told you guys about it. But anyways, why don't we just see what the company is about and the shareholder interest of the board of directors. So this is the chairman and CEO. Okay. Strives to provide the world's best customer experience every day, thanks to the efforts of his colleagues around the world who deliver the promise, our brand promise to powerfully back our customers, colleagues, and communities. Fantastic. Okay. Leading with digital innovation. So where can I find your interest in the company? So basically that's a good sign. So if a majority of the stakeholder is the actual CEO, that means that they're more dedicated to actually seeing the company succeed. So yeah, I don't really know where I can find that. Investors, okay. Yeah, I don't see anything. So we're just gonna search uh company or Amex board of directors interest. Okay. Interest share. Director stock ownership. Here we go. So, Charlene Barshifan has 65, is this millions or billions? I don't know. 65 thousand shares. X out of this. Okay. And let's go back to Amex board of directors and see who these people are. So first up, we have Charlene. Let's go back to here. Charlene. Okay, who is Charlene? Hi, Charlene. So she's the senior international partner of Wilmer Hale. Okay. That's who not who we're looking for. We're looking for this guy, Stephen J. Sequeri. So Stephen has no shares in the company. So bad sign. I think as the CEO, you should have some number of shares in your company and some level of direct stock ownership. So really bad sign. That's something to watch out for. And was I looking at the right tab here? So number of SEU is number of shares. Am I wrong on this? But who are these other people? Like, is the vice president at least have something? Doug Buckminster. Doug's got nothing. Okay. What about Mohammed? Mohammed has nothing. Okay. Jeff Campbell. Jeff has nothing. So maybe this is the wrong, maybe it should be the board of directors. So Thomas E. Baltimore. Okay, nothing. John Brennan. There you go. John Brennan is there. So some are there, some aren't. Peter Chernin, Clayton, De La Vega. So De La Vega is there, Chernin is there. So some of these people are there, but the CEO is not there. So that's a big red flag in my opinion. He should have a majority of the stock ownership. So skin in the game or soul in the game, 0. Inside ownership, basically, I think that's also meaning that they have some type of ownership interest. Probably I'll just give it like a 1. Now let's go to Glassdoor ratings. So let's go to Glassdoor. Okay, I have to just continue with an account. Let's go with this one. Let's just go with my Facebook account. Okay. So let's search up this company. Let's say I'm a student. Job title. Location. Philadelphia. Do I really have to go through all this? Like, come on. Oh, okay. Here you go. Just search a company. All right. So American Express. Yeah, I could have done that. All right. Let's see the reviews. Okay. So Glassdoor ratings are add your review or salary to continue using Glassdoor. Um, just do interview. Mm, Okay, this is really, really annoying. I don't understand why I can't get through Glassdoor. Um, and they're just making me sign up for all this nonsense. Um, just search up American Express, please, and just give me the reviews. You know, just do a company review. How about that? Okay, so I think like you just have to uh just go through this, but whatever. Just give me like American Express Glassdoor ratings. 4.2 out of 5. Okay. Not terrible. I think that's solid. Not the best though. So I think we'll give it like a 3. Okay. Mission statement. So, simple, inspirational, optionable. I didn't mind it. That was like a okay mission statement. 5-year performance versus S&P 500 or since IPO, 50%, 100% gain. So basically we would go to Yahoo. We would look at the I have to find it though. I don't know where it is. What's annoying about this is that you pretty much just have to sign up for all of this to get access to the historical data. So I can't make any inferences um as far as how they did, but they do have this. So growth estimates past 5 years, 7.97%. Um, okay, next 5 years, 7.5%. Okay. Um, earnings history. So is this really history? Like just a year ago? Like I'd rather see like 5-year history. But but earnings from quarter by quarter beat it. They beat it here, they beat it here, and they underperformed here. So yeah, can't make really any inferences on that, but I think I'll just give it like a 2. So this isn't honestly like the best score in my opinion, just because I don't have access to like the data. But I would just base it maybe just off of the 10K report and your opinion of the press releases that they hand out, right? So I would definitely look at both of those and just make a wise investment decision of how you think the company is going to perform. And so yeah. And shareholder friendly activities, buybacks, rising dividends, debt repayment. I don't have too much info on that. So yeah, I don't look at this score. I'm just putting this as kind of a disclaimer. Just don't put this score as something that you would be influenced by, just because I'm a novice to this, and I'm sure a lot of listeners are also novices. So I would definitely do more research or contact like a friend or maybe a professional financial advisor or someone who even who works at a stock trading company, So whether that's like Vanguard or other companies that do TD Ameritrade, like all those different types of companies, like just reach out and see if they have any opinions. But definitely this was pretty cool to see and just understanding like which resources to look at. And so I definitely do this again. And I think I will be doing this but I'll do it like once it's already done. I'll do my own analysis and then I'll explain all the different types of areas which I think have done well. So I'll just keep up to date on that and just see where that goes. Definitely some very interesting stocks to go through. Obviously, you have the big FANG stocks, which are fantastic. Then you have some growth stocks such as Airbnb. You have some real estate stocks such as Prologis. So definitely a wide range of products and industries to go through. Yeah, okay. And then they also this is Brian Stouffer's score. So he has kind of like this anti-fragile score, which kind of simplifies it a lot, in my opinion. Brian Feroldi goes more in depth as far as all the things, but he just has like this anti-fragile score that he goes through. And pretty much just does it off of that. So this barbell method, mission statement, moat, optionality, very simple, straightforward. Cash, debt, free cash flow, okay. Concentration, okay. Skin in the game, obviously Glassdoor ratings, the founder if he's involved, and the ownership as well. So yeah. And then if you score above 12, it's a anti-fragile score. 7 through 11 is robust, and below that is weak. So, excuse me. So yeah, definitely if you're interested in evaluating stocks, I would definitely check out this checklist by the Bryans, I would say, Brian Feroldi and Brian Stouffer. And for future videos, if you're interested in learning more about stocks, definitely come to this channel and see what type of content that I'd be posting. And in the future, we're going to be doing this channel not just on stocks, but other types of investments across like ETFs, mutual funds, even like bonds as well. So it'll be kind of an investor's podcast in a sense. So yeah, so thanks again for tuning in. I hope you enjoyed today's video. I know it was pretty lengthy and I'm still going on and on right now, but I'll cut this time short right now and I'll see you guys in the next video. All right, peace.